Hi, good morning, everybody, and welcome to the EOA webinar on how to become employee-owned. Absolutely delighted to be hosting this webinar today in a bid to help you understand more about the journey to becoming employee-owned, the technical requirements, and all the real-life examples that related to it. Um, so I'm delighted to be joined by members of the PwC team and also individuals from Amberleigh Care who are going to bring that real life experience to life for us. I'm going to hand over to them relatively soon for a presentation, but firstly, I'll run through the agenda of how this webinar is going to look. So we're going to do a welcome, and I'll continue to do that. Then we're going to hear from Andrew Neely, who's a partner at PwC, all about employee ownership trusts, the technical details that you need to be considering and what that journey looks like. Then Kevin Gallagher from Amberleigh Care, who led the transition to employee ownership, and it's fairly recent, so it all feels very fresh in his mind. He's going to tell you about that journey so far, becoming employee owned, and what life has been like since. He's also going to be joined in breakout conversations later on by a couple of colleagues, Trudy and Kelly. They're going to tell you all about the employee experience of that transition to EO, what it felt like for them, and what life has been like since. After the presentation, you'll get an opportunity to ask any questions you like. Please do use the chat feature within Zoom in order to do that, and I'll then pose those to our panelists. And then that speak to an expert section, that's where you'll join breakout Zoom rooms. You can move between those rooms and get to speak to various people and ask the questions that you might not have been able to ask within the Q&A. And we'll get done by 12:30. So a little bit more about the sector. You may be relatively new to employee ownership. You may have read an article about it and think that could work for me, but what could the impacts be? So the EOA has done a great deal of research, and we've got evidence that demonstrates the significant impacts of great employee ownership. It's not an automatic panacea. Your business isn't automatically going to be magical and incredible as you become employee owned. There are various things that need to be put in place, and we can help you with that. But improved productivity, greater investment in training and skills, a boost in performance and revenue, and you are more likely to be paying and rewarding your colleagues than those businesses that are not employee owned. What greater reason could there be? In addition to that, talk a little bit about our membership. So we have nigh on 800 corporate members. We've got PwC, as you can imagine. There are some other names on there, some of them you might be familiar with, but the majority of our members fit into that SME space. Usually joined because it's a part of a succession plan. Could EO work for my business as I look to leave, maybe to retire, or look for the next venture or an organization? So what we do as a business, we help people understand and explore what employee ownership is. And on the screen right now, you can see how we do that. We help you transition, but we leave the technical insights and the expertise to the likes of PwC. And then once you are employee owned, what does it mean? What is employee ownership, but equally what is not employee ownership? How to leverage the advantage of being employee owned for the team, for the economy, and for society as a whole. And also, we are a great space for professional advisors because they're the experts to be referring to across all of that journey. In particular, what we do, we provide learning and training courses. So what you'll see on the screen is just 3 examples that we've got over the next couple of months, but we've got a portfolio, all relevant to the employee-owned sector. First one you'll see that's coming up in June. You will need an independent trustee. If you haven't got one in mind already, you want one that's very well skilled and trained. There's a course for them. And equally for your employee trustee director. An employee might have enthusiasm for employee ownership, absolutely, but do they have the skills and the knowledge in order to be an effective director on the trust board? And finally, shaping the employee owner mindset. How can you get the employees to feel and behave and think like owners? There's a course there for that as well. Keep an eye out on our website for more information. And likewise, we do a host of events. These are the ones that are coming up over the course of the next 3 or 4 months. We do put in person, we do face-to-face in person, but also do webinars such as this as well. If you're a member, you can book for the 2 events on the outside, the 2 face-to-face exchange. If you're not yet a member of the EOA, the one in the middle could be relevant for you, hosted in central London on the 1st of September as well. And also what we have coming up is our EOA annual conference. So that is 2 days down in Telford, 25th and 26th of November. If you scan that QR code, you can get on a priority list, and we actually open for ticket sales today. 850 people, 2 days, celebrating all things employee ownership. I would very much encourage your consideration of coming along to that if you haven't been before already. And finally, if you are employee owned, you're an advisor or you're nearly there, we've got EO Day coming up on the 20th of June. That is a celebration of all things EO, with the theme being EO Smile. How can employee ownership make you smile? It's another date for your diary. So that's an introduction to the EOA, very brief, and we'll cover it off later on as well about the opportunities you've got as members. But equally, if you're not yet a member, we'd be delighted to speak to you. So I'm going to hand over and introduce and hand you over to our first speaker. So Andrew Neely is a partner at PwC, very well experienced in all things employee ownership. And then he's going to hand over to Kevin from Amberleigh Care, who are a PwC client who've recently been through that transition. So Andy, over to you.
Great, thanks very much, Ollie. And thanks everybody for taking the time out of your day to attend. I'm Andy. I'm a director at PwC, specialising in reward and all things employee equity. And over the last few years, lots of employee ownership trusts in particular as well. So I'm just going to talk to you in this section a little bit around background to EOTs, the main tax requirements and considerations, and then when we've seen EOTs being most appropriate and working best, and then a few examples of when sort of they might be less appropriate. Just walking through the background to EOTs. So they were introduced in the Finance Act in 2014, all part of the government's aim of promoting employee ownership as a business model in the UK. Very much sort of looking at the John Lewis model and trying to find more businesses to follow that type of approach. Can be seen as sort of an extension to the traditional employee benefit trust, but with additional tax advantages. And in particular, the main one being that provided that the qualifying requirements are met, so that the EOT acquires a controlling interest in the company, the selling shareholders can sell their shares free from capital gains tax. And also, once companies are employee owned, they can pay income tax free bonuses of up to £3,600 per year to each employee. It was quite a slow start in terms of EOTs. There weren't many we saw in those sort of early years from 2014, but there's been a massive growth in the last few years. And there's now approximately 2,300 employee-owned businesses in the UK, and 1 in 20 private business transactions is now to an EOT. And you can see that sort of exponential growth on this slide, where there was roughly sort of 50 EOT transactions in 2018, 2019. And then close to sort of 850 in 2023, 2024. It's very much something we're seeing across the sector. And if you go to the annual conference this year, the numbers grow and grow each year. If we move through, so just in really simple terms, what does the before and after look like? So beforehand, we have individual shareholders holding shares in the company. And then afterwards, the EOT will hold more than 50% of the shares in the company. And that can be up to 100%. So it'll be anywhere between 50% or just over 50% and 100%. And you might therefore have 100% employee owned, or you might have a combination with some remaining individual shareholders in the business. If we keep moving through. So what are the main tax requirements that need to be met in relation to an EOT transition? So first and foremost, the EOT's got to acquire a controlling interest in the company. And in summary, that means that it's got to acquire more than 50% of the shares in the company. And that means 50% of the voting rights, 50% of the profits available for distribution, and 50% of the assets on a winding up. The company being acquired has got to be a trading company or the principal company of a trading group. The specific terms is to the trust and how the property must be held, which must be on behalf of all of the employees on the same terms. And then there's a limited participation requirement. And this is essentially that the selling shareholders, or shall we say the selling shareholders who hold more than 5% of the shares in the company can't constitute more than 2/5 of the company's employees. There were then additional requirements that were brought in following the October budget last year, in particular being that the EOT's got to be a UK tax resident trust. The majority of the trustees must be independent, so they can't be what's called excluded participators, being those people who hold more than 5% of the shares in the company that are selling their shares to the EOT. And then the EOT's got to take all reasonable steps to ensure that it's not paying more than market value for the shares in the company as well. And then finally, the disposal's got to be reported on the shareholders' tax return for the relevant year with certain information in relation to the EOT transaction as well. This just sort of shows in kind of quite stark form a comparison to BADR, which is the other sort of historically the most favourable way to sell shares, and really just shows that the tax rate at 0%, there's no limit on that. There's no holding period required before the shares are sold. There's no shareholding requirement, and there's no sort of employment or office holder requirement. So just sort of shows the tax benefits of the EOT. So in our experience, so this next section just talks on when we've seen EOTs as being appropriate and working best, and when sometimes maybe it might be not the right route for your business. So often we see it working best where there's private companies with founder shareholders who are sort of at or around that sort of retirement age and looking to sort of have a realization event and sort of look at succession planning in relation to the business and what does the next phase of its business ownership look like. Often they might have looked at sort of alternative exit routes, but they might have thought that they aren't viable due to or the right route. There might not be the right offer from a third party. And often we hear sort of tales of how founders and shareholders seen other businesses in their sector that have been bought by trade buyers or private equity, and the business has really changed in subsequent years from what they'd originally created. It might be simply the name's changed, it might be that there's redundancies, it might just be operating in a different way, but actually they don't really want that to happen. They want to maintain that legacy and that sort of culture and pass it on for the benefit of employees in the long term. This route sort of allows selling shareholders to retain a minority interest too and still be involved in the company going forward as well. Other sort of advantages, we've talked about the tax, we've talked about it's very flexible in terms of the trades that can qualify. It's very flexible in terms of payment terms as well, in terms of upfront consideration and deferred consideration. Also, advisors' fees are usually often a lot lower than if you went down that sort of third-party transaction route, and the sale process is a lot shorter as well. If we move to when an EOT is maybe not appropriate, which is sort of just as relevant and pertinent, often there might be a potential buyer that's willing to pay a premium, and a buyer might be more of an appropriate route through, there might be additional investment and knowledge and resource they might be able to bring to the business, and that might be the right approach. There might be another shareholder or management buyout structure that might be more suitable. The company might have corporate shareholders who won't benefit from the tax reliefs. Often there's a point around control, and those sort of current owners want to retain that full equity ownership in the company, and it's just too much of a step to think of the EOT holding the majority of the shares. There might be overseas individual shareholders who won't get the tax reliefs, or overseas employees who won't benefit from the income tax reliefs and might be unfamiliar with the concepts. And we also see often companies with wide shareholder bases with all sort of differing interests and holdings, often potentially through trusts and nominee structures that can just make it a little bit more complex. Not necessarily that any of these reasons are a showstopper, but just sort of things to think about as to whether an EOT might be relevant for your business. So that's sort of a bit of an intro for me, and I'll pass over to Kevin from Amberleigh as to their experiences.
Hi there, thanks Andy, and thanks very much to Ollie for the invitation. It's great to be with everyone this morning. Just going to spend a few minutes talking through our experiences You can move the slide forward, please. That's great. So just to give a little bit of background, really, we are a specialist private sector residential care and education service, established back in 2004, so operating for 20 years, very much an SME. We've grown organically, started in Wales, and then grew to a second site in Telford in Shropshire. So we have 2 operational sites, care, education and therapy, 100 plus employees. We care for up to 32 quite vulnerable and complex young people on behalf of local authorities across the country. I joined the service in 2015 as managing director, and that role was being created at that point specifically to think about a retirement plan for the original founders. And so in 2017, we did a management buyout that allowed the founders to retire. That was self-funded by our bank. And there were 5 directors from that point, 1 who subsequently retired, and a second that left the service during the pandemic. So there's been 3 of us who are the shareholders, working full time in the service in operational roles. So there's myself as managing director. We have a finance director who's been involved in the service since it was founded, and then a director of operations. We've got a fairly small management team, 9 staff in the management team, and it's a very child-facing organisation, very values-driven, quite technical. As I mentioned, the service has grown organically over the years. It's commercially very successful. We offer a service at a price point in our market that is very mid-range in terms of its price point, but very high in its technical competence. So it's a very strong value for money offering for local authorities. But I think in terms of our context and talking to some of those reasons why services start to think about succession planning and what was right for us, we have to kind of think of the operating context. Outsourced services for children have been around for 30 years. The private sector now makes up 85% of that delivery across England and Wales. That's residential care and fostering. Within that, and over the last 20 years or so, there has been an increase in private equity and venture capital backed businesses, consolidation, smaller services being bought up. But we still have a sector where about 65%, 60 to 65% of the independent sector are SME provisions. And many of those have got profiles a bit like ours, founder practitioners or management teams that have been working in the services for a long time, often offering specialism or local services that have evolved over a number of years. So across that period, and particularly in the last 10 years, like all businesses, you operate in a complicated landscape with lots of moving parts. So we've seen austerity affecting local authority budgets. Demand has been increasing, the complexity has been increasing. The way that services are organised isn't always as efficient as it can be. You then get different complications from the way that local authorities commission and access services. That drives rising costs at a time when local authorities have got less and less money. So it then feeds into a political agenda, both at national policy level, but also in terms of individual local councils and how they might be operating in different regions across the UK. As a specialist provider, we work with young people from all over the country. So in those, if we looked at it from a market perspective, it's a relatively mature market, and we do see a gradual increase in the prevalence of kind of private equity-backed businesses. But there's also a political and a local authority narrative that is saying, and that's not working for us, and we need to do some things differently. So that's the kind of context that our 20 years of operation finds us in. Next slide, please. So then we start to think these next two slides really, I think, bring to life the slide that Andy talked about when he was talking about the reasons why. I think if we look internally and we think personally, as I said, there's three of us as the directors. Two of us have just nudged the wrong side of our mid-50s. Our third colleague is a little bit younger. We all work absolutely full-time in the service and have done right the way through. So you start to think about, okay, over the next 3, 5, 8 years, what does that look like as you enter a different stage of life? You know, I've got elderly parents to start to think about. There is an element where you start to think about some return on the investment that you've kind of put in over a period of time. You know, the banks having second charges over properties and those sorts of things over the years. And you start to think about the succession planning for the service. I mean, when you're in, for anybody that's in and running a service, the kind of passion and commitment that's required to take that forward, that's one of the things that keeps you going. It's also one of the things that feeds into the kind of leadership role and your culture in your organisation. So you start to think about, how does that get protected? The management team that we've been working with for a long period of time now, as they evolve and grow, where are the next kind of people coming through, so we can start to think about kind of handing the baton over? And then thinking about some of those sector specific contexts, you know, we've got a technical service that we want to protect moving forward. We've seen, as Andy's touched on, especially in our sector, specialist services absorbed into bigger structures and losing some of the essence of what made them special. And there's also, you know, moral and ethical considerations about, you know, for us, it's public money that funds our service, thinking about local supply chains, thinking about our staff, thinking about wanting to protect the amount of voice that our young people have in the running of our service. There are a lot of kind of strong values and practice considerations that we feel are essential moving forward. And some of that is about personal legacy, but some of it is also about where the service fits in the kind of wider operating landscape that we're in. Next slide, please. And so thinking about those external agendas, as I touched on, you know, there is a political agenda in England and in Wales. Our service is either side of the English-Welsh border, so we have those differences to take account of. There is a focus in our sector on value for money, efficacy, UK-based services, where is tax being paid, levels of debt in services, which is ultimately being funded by the public purse. And then there's an issue about keeping diversity of provision for local authorities. And without getting too technical about it, the local authorities require a broad spectrum of different sorts of children's homes provisions across the country, and we don't quite have the right mix of that. So protecting diversity and localism is important. It helps us to kind of respond to, there's quite a negative you know, media narrative, because it's quite emotive, the idea of how children's services are funded. And we wanted to think about something that was sustainable and ethical, and definitely an alternative to private equity. I think for our service and for us as individual directors, that's not a route that we would want to go down. And I think that I'm aware that there's one or two organisations in our sector that have already gone down this route. And I know that since we've been sharing a little bit of our journey, I'm having quite a number of conversations with other colleagues, I think some who are even on the call this morning. So that's great to see. I think there is real mileage for this as a robust and ethical model for our sector moving forward, because we're at a point of change in that market. Next slide, please. So in terms of the journey, it took about 6 months. We've been talking about it internally as a trio of directors, probably for a couple of years, in terms of wanting to start to think about a route forward and having to navigate changing political landscapes. And then we came across employee ownership almost by accident. And And as soon as we started to understand a bit more about how they worked and how they were structured, it was instantly apparent to us that this was going to be a good fit for us as a service and right for our sector. So our management team, we've been talking to them openly about the idea that we were starting to think about succession planning for a good year or 18 months. And then once we had landed on the kind of EOT route and then started to make a connection with Andy and the team at PwC, we've basically kept the management team involved all the way through the process. One of the things that we found is that for us as a service, because we're working in social care and partly because of our therapeutic practice model, we already have very significant levels of employee engagement built into our working system. We already hold Investors in People Gold Awards. We do an annual employee survey. We have all kinds of councils and other consultations, and we're very visible as directors. So the sorts of structures that you would expect to see in an EOT business, we were already doing a lot of that to a high degree. So that hasn't been a big learning curve for us, but definitely I can see that for other businesses and maybe in other sectors, that might be new things to learn, but that wasn't an issue for us. With PwC's help, we were able to fund this through our own bank and our existing lenders. And it's allowed us exiting shareholders for us to realise 20% of the upfront consideration with a schedule of deferred payments over the next 5 years and then some refinancing. So in terms of continuity of the service, no one's going anywhere, but we've made a change that now creates the structure for us to engage in that succession planning with the management team in a very mature and measured way. I think that we've had some subtle shift in our branding, just talking about better together that you'll see on our logo. But really our identity has remained completely consistent and the same. And we're just now starting to share some of this journey within our own sector and with other colleagues. But you've got a couple of members of the management team here in one of the breakout workshops. So, I mean, feel free to kind of talk to them about, what it's been like from their perspective. Next slide. So this is the last one from me, really. What happens next? We've obviously established our trust. That was one of the final pieces of the jigsaw. So we were introduced to an independent trustee. We fund our trust, and our trust is now providing that overarching governance that allows the trading company and the management team to continue to deliver on all of the things that have made the service successful. That kind of values-based, evidence-based, outward-facing social value, local supply chain, all of those values are the things that are now baked into the way that we move forward. And that's one of the benefits for our employees. They engage really, really positively with the news. I think they had a high degree of trust and confidence because we're very visible to them all. We're working in and with them every day. So I think that kind of helped. We're now starting to implement and develop a new EMI scheme, an incentive scheme for the management team. So we'll be putting that together over the next few weeks. There'll be some continued involvement of our employee engagement approaches, but as I say, we were doing a lot of that already, and starting to get involved in taking this conversation externally, like events like today, and definitely within our own sector. We start now to have conversations with the management team about individual developments and what that looks like. So I've actually got some time with my two director colleagues this week to sit down and start to map out what that kind of 3 to 5 years might begin to look like, so we can then bring the management team into that conversation and really start to flesh it out. So it's been great. It's been busy. It was quite a moment to kind of get there at the end of the process and to have completed the process. And now I think we're just taking a breath and settling into it with our colleagues and looking forward to what the next few years will bring for the service. So that's it. Thank you very much from me. I'm going to hand back to Andy and look forward to taking questions later.
Yeah, brilliant. Thank you very much for that, Kevin. And I do think that it's a brilliant story. I think that Amberleigh is a really good model for how EOT can be done and done well. So I would encourage everybody to, I dare say you'll be inundated with people wanting to talk even more about it to you, Kevin, but so they should do. Great. So I'm just going to touch on a few final sort of points that if you're looking at doing an EOT might be on your agenda. So first of all, legal and commercial considerations and what the main ones are, control and governance, employee communications, and then valuations. I think the slide formatting has got a little bit funky there. I'm not sure if for other people it's the same. If we can zoom out a little bit. If not, I'll crack on. So key sort of commercial and legal considerations. So first of all, the selling shareholders have to consider who's going to sell their shares and in what proportions. And as I say, there's quite a lot of flexibility once you're above that 50% threshold. And we've seen quite a number of different approaches. So different sellers selling different proportions of their shares, potentially selling for different amounts as well, provided that nobody's selling for more than market value. And with different deferred consideration profiles as well. So that's sort of when those payments are made, being the amount up front and then the amount deferred, is also quite flexible. We've seen different companies take different approaches in relation to that. In terms of existing incentive schemes, they'll need to be considered. So on Amberleigh, Kevin, I'm sure you won't mind me saying there was an EMI scheme and we had to consider the implications in relation to that. And then similar sort of employee equity schemes will need to be considered on the impact of the EOT transaction on those. The purchaser will be the trustee of the EOT effectively, and one of the main considerations that we'll talk about is who should be the trustee directors of that EOT company. And then the target company will typically be that holding company of the trading group. If we move forward to the next slide. There we go. Oh, I think we might have. Yeah, here we go. Yeah. So in terms of, as I say, there's then what form will the consideration take and what the structure will be. And again, as I say, there's quite a bit of flexibility in relation to that as well. So there'll typically be some upfront consideration with using sort of the company's existing cash on its balance sheet. There will be, and then there'll potentially with additional debt taken on by the business. And then there'll usually be deferred consideration, which may last over a period of years. And that upfront and deferred consideration, as I say, will be funded through cash in the business and its future cash flows plus any incoming debt. As with any sort of transaction, there will be certain provisions that the selling shareholders will be subject to. So in particular that they can't compete with the business and they won't solicit employees, customers, suppliers, etc. And there'll be standard representations and warranties as to their shareholdings and the solvency of the business, etc. They will be typically quite a lot lighter than if there was that sort of third party, PE or trade transaction, really on the basis that on an EOT transaction, all parties are quite aligned because the business needs to be successful, needs to fund the EOT, needs to pay off the deferred consideration, and everybody's effectively on the same page in that regard. So it will typically be lighter than you might see in a sort of trade or private equity type sale. If we move through. Then on to sort of control and governance. So what will the EOT actually do? So who are the trustees? So typically the structure we see is that there'll be a newly established company limited by guarantee, and then there will be directors, members of that company. And they'll typically be a combination of the selling shareholders, management employee representatives, and an independent director. with that, note that the majority of those directors can't be those selling shareholders. So what role does the EOT board and the EOT normally do? And I think Kevin sort of alluded to that. Initially it will play that role of a relatively passive shareholder. They'll typically have sort of quarterly meetings where they'll be provided with the company's latest accounts. They'll look at the ability of the company to pay the deferred consideration. They'll want to know about significant developments affecting the business. They'll want to talk about employee benefits and remuneration and have that as a topic, including the ability to pay the 3,600 tax-free bonuses. They'll want to be consulted about any significant transactions affecting the company and any sort of shareholder related matters, such as change to the articles they'll need to consult on and approve. And then often we see a governance agreement in place as well with certain specified consent matters that the EOT will need to approve as well around those sort of matters that I've mentioned. If we move on to the next slide. Then the key things that all companies will need to think about will be around employee communications. And Kevin mentioned the approach that Amberleigh took there. I think that the three key things there are the when, the what, and the how, and when to communicate, what to communicate, and how you communicate it. And companies do take really quite different approaches in relation to this. We hear examples where 2 years out from thinking about an EOT, they'll consult with employees at all levels and garner their views in relation to it. But I think probably the most common route is that what we'd see is sort of similar to, as Kevin explained, that you'll typically consult with your key management team fairly early on in the process, where you want to make sure that they're on board and they get it and that they're they have their buy-in. And then typically there'll be a more wider communication to employees, sort of normally either after clearance has come back from HMRC or on or around completion. What to communicate is quite interesting, because I think that often when we talk to shareholders and companies, their perception of what employees are going to be interested in is quite different to what they are actually interested in. And often sort of employees first and foremost will be considered around their job security. And they'll want to know in particular whether there's going to be any big changes to how the company's run, whether the founders, the management team are going to move anywhere, and whether there's going to be any big changes to the overall structure of the business. And I think really one of the main things is sort of allaying those concerns is really important early on. Really sort of describing that it's a case of sort of evolution rather than revolution towards an EOT, and actually this is part of that sort of long-term succession and sustainability of the business, and actually how it is really quite different in that regard potentially to if there was a big transaction from a third party coming in. So I think that's sort of the key messages to be thinking about communicating, along with the sort of long-term benefits that employee ownership can have. In terms of how to communicate, that really will vary depending on how companies communicate with their employees normally. It may well be that for some, there are, say, 15, 20 employees, and they'll get them all in the room and just describe it all and let them know in that way. Other large companies might have town hall presentations, emails, intranet updates, employee representatives and management at different levels and geographies who will often sort of cascade information. But really that key is being sort of open, transparent and clear, and making sure that they understand what's happening and what the impact will be on them. Finally, just sort of touching on valuations as one of the other sort of key areas. And as I think we sort of mentioned, there will be various breakout rooms, including one on valuations. So a couple of my valuations experts there will be able to talk much more eloquently than I, but effectively there will be this valuation of the business that will be required. That'll typically follow a sort of market approach. So you'll look at the EBITDA of the business, and then you'll look at appropriate multiples that should be applied to that. Often an EOT transition might follow an alternative sale process where there's been other offers for the business, and often they will be a useful, interesting starting point. In terms of the main risks is that overvaluing the business, and to that end, the valuation does really need to be robust. It needs to be able to stand up to HMRC challenge, and the trustees need to be comfortable with it and make sure that they're satisfying that requirement, that they're not paying more than market value. In terms of approach, we often see sort of a phased approach to it. So often there'll be an initial valuation work stream sort of carried out that does that initial analysis, make sure that aligns with shareholder expectations, and then there will be the longer form full valuation, which will be completed at or around sort of the final transaction date. So that's all from me. There's a sample there of the PwC team, so we sort of cover all aspects of tax, legal, valuations, debt advisory. And those people there on that in that group there will be joining the sort of dedicated breakout rooms for questions following this session.
Fantastic. Thank you, Andy, and thank you, Kevin. I'm going to kick us off with a couple of questions, and they've started coming through the chat as well. First one is, can we share the slides? The answer is yes. So if you've attended this meeting, this webinar, we will email the slide deck over to you to have a look at. Kevin, can I come to you first? Just on the topic of governance, Andy talked a bit about the structure. He talked about independent trustees and the trust board and how that operates. Can you just share with us the detail of your trust board, who sits on it, and what does that look like?
Absolutely. So as I explained, there was 3 selling shareholders and a little bit of there was an EMI scheme for the existing management team when we entered in the transaction, and we've sold 100% of the shares in the trading company into the trust. So when we set up the trust, we've got 3 trustees. We were introduced to an independent trustee with some different candidates actually, and we went through a kind of a selection process and identified someone who was a good fit for our service, someone who's experienced and sits on as an independent trustee for other shapes of businesses as well, which was useful. And then there's myself as a trustee representing the kind of exiting shareholders and a kind of leadership representative. And then we have a member of our management team who acts as the employee representative. So somebody with long service, that's Kelly, who's on the call, and then supported by our HR manager. So I think three trustees to get the show on the road, I think, is probably the most common model as I understand it. And it means that in terms of the kind of exiting shareholders, I'm outnumbered 2 to 1 by the other trustees in terms of meeting that criteria.
Thanks, Kevin. So you've got a couple of hats that you wear then, obviously as managing director and also sitting on that trust board. What are you conscious of as to your behaviours, if I use that word, from being sitting on the trust board to being the MD?
I think it's I mean, this is something that we talk to the management team about as part of the process. So in essence, the thing that's changed is that I'm no longer an individual shareholder of the trading company, but my employed role as managing director to lead that trading company is completely unaffected. And my position and obligations as a director of the trading company to make sure that it runs safely and legally and successfully, that remains in place. And actually fulfilling those responsibilities is one of the things that then underpins my contribution to the governance that happens at the trust level. It's almost like a virtuous circle. In order for us to ensure that the company runs successfully for the benefit of the employees, that's intrinsically linked to the quality of outcomes that we deliver for our children and the success of the trading company. So it's quite easy to be able to see the relationship between the trust board and the day-to-day running of the operational business, because ultimately the running of the trading company is what generates the income to fund the trust to make sure that we are working in the best interest of employees and offering good social value and reinvestment. So that's how it works in practice.
Thank you. Thanks, Kevin. Andy, question for you. For your EO insights, what difference are you seeing across the regions of the UK in relation to employee ownership?
Yeah, it's a really interesting question, that, Ollie. If I look back at the EOT transactions that we've done over the last few years, they really have been all over the UK, to be honest. I think that we've done them in Scotland, Wales, England, Northern Ireland, so all sort of four corners. I think that what would I say? I'd say there's no reason why it should be any different across different parts of the UK. I think that when we've spoken, Ollie, before, I think you probably said that there's been fewer in the Midlands for whatever reason. I'm not quite sure whether that's a sort of sector reason there, but that's the only one thing that I can think of that as to sort of differences. But really, we see them everywhere, and there shouldn't really be any difference.
Absolutely. Geographical location isn't a factor. Neither is, in the majority of times, the sector. People-based businesses, whether you're in professional services, manufacturing, retail, creative agency, whatever it may be, EO is a potential option for anybody. Another one for you, Andy. What challenges are created from partial sale, more than 50%, but less than 100%, that don't exist when the shareholders sell in full? So what challenges are created from what this person referred to as a partial sale, so less than 100%?
Yeah, I think it's always interesting, this sort of pros and cons as to whether you should sell 100% or whether it should be sort of closer to the 51%. And I think that sometimes third parties will be interested in seeing that there's that continuity and that investment from those sort of selling shareholders. So, for instance, Kevin talked about lenders, customers, suppliers. They want to be, one of the key things that they will be interested in is, although that management team, those founders who we're familiar with and we know, are they going to stay around? They're not going to just walk off into the sunset. So actually sort of a minority shareholding there can be useful in that regard. Similarly, if the business ever gets into any difficulties, the fact that they might be able to put some more investment in the business through that shareholding in that way can be relevant. There's also a little bit, I think, that some really just can't, conceptually give up that full 100% control. They want to retain a slice of the ownership, and they think that there might, just in case, say the business in 5-10 years time, there is this huge offer that comes in for the business, or it is that the other, they would like to have some potential skin in the game for that to happen. So there's that aspect to it. There's also a little bit just around if you're putting in place post EOT incentives as well. If you sort of right up against that 51%, there's a little bit of kind of, if you want to put in place a new equity scheme for your employees, managing that so you don't dilute the EOT below the 51%. So it can be helpful of having a little bit of a buffer in that regard as well. So there's a few reasons why, some companies will go the full 100%, some will go sort of closer or at the 51%.
Okay, thank you. Andy, another one for you, but Kevin, if I can bring you in as well. So, Andy, what responsibilities and risks does the trust take on, financial and legal? And if you can add on the back of that, Kevin, what have you seen in reality for the trust board and the decisions that they're making so far in your early journey? So, Andy, to you first.
Yeah, it is a good question. I guess first and fundamentally, the EOT trustees need to make sure that they're acting in the best interests of the employees of the group. So they are making sure that the company is being run for the benefit of employees and effectively providing that appropriate challenge when they have their meetings to the trading company board. Beyond that, they need to make sure, of course, that deferred consideration can be paid as and when it falls due. But then equally, I think that when it comes to Kevin's point, there's a hell of a lot of alignment in terms of between that trading company board and the EOT board. And actually, when we do our share purchase agreement, we always have provisions that that deferred consideration is always subject to provisions that it won't have any sort of material adverse effect on the business. It won't put any undue stress on the business. So really that ensures that the trading company and the EOT are aligned. And it's really just then making sure that, yeah, the deferred consideration's paid and that effectively employees are seeing benefits in the long term.
Yeah, and I think from our experience, we're only kind of two trust board meetings in so far, but I think there's another impact in terms of being introduced to the independent trustee as part of the process of setting up the trust. So particularly in terms of that requirement to really scrutinise the valuation, the independent trustee was able to work with our finance director to understand our service and its budget and what the moving parts are, and to look at the forecasts and projections, and to be able to kind of ask those questions, look at trading history, look at what we were saying moving forward. So that kind of scrutiny that you would expect for any kind of business plan. I mean, ultimately the trust is the shareholder, so we're being scrutinised in that respect. They were also really helpful in terms of, as we were drafting our employee comms and then getting to our kind of launch, really helpful to have the input from an experienced independent trustee that could bring, experience from elsewhere to add to the expertise that we were getting from Andy and his team. So it all felt very kind of planned and organised, and we knew what we were doing, and it unfolded in a natural sequence. And I know that at our next trust board meeting, we're now going to be focusing on the next way of, taking this conversation out to employees more. Now that employees have had, an initial few months to see, oh, actually day to day, nothing's really changed and we're all carrying on. There's now a conversation about, okay, so how do we make this idea much more live with the employees? Because moving forward, that will have implications in terms of recruitment and retention and how we kind of position ourselves as an employer in our landscape and so on and so forth. So those are the things that we're going to be looking forward to doing more of. But in the short term, it's about making sure that we deliver on our business plan and our projections the same as we would have done before we became an employee-owned trust. So far, all great, all helpful, and we kind of know what we're looking at in the next few months.
Good, thank you. Andy, this one's for you. So owner's son is an employee in the business, so connected to the selling shareholders. How does that work? Implications?
Yeah, so technical one. They have to sort of get all of the facts. I'm more than happy to sort of pick up separately with Claire there. I guess there's a number of sort of things to consider in relation to it. So first and foremost is that excluded participators test that I mentioned, and making sure that the selling shareholders and their connected persons don't form more than 2/5 of the employees. There's then the point around the payment of employee bonuses, and actually this is an interesting one because a selling shareholder's son and the selling shareholder should be included in terms of getting those employee annual bonuses. And then the first one, finally, in terms of sort of participating in the EOT is quite interesting, because actually in terms of the trust assets and participating beyond that, really actually assets will only really flow from the trust if it ever sells those shares and it gets cash in the future, which is effectively a second share, which is relatively unusual, really. Most businesses don't go into it on that basis, but they'll be then sort of considering whether that former owner's son will be able to benefit from those payments, and I wouldn't expect that they will be able to do so. So a bit of a interesting one there, but happy to pick that up with Claire separately.
Thanks, Andy. And Suzanne, your question, are there any examples of successful companies who have continued to thrive after the shareholders have retired and moved on? Yeah, short answer is yes, lots. And many of those sit within the EOA network. So we've been more than happy to connect with those so you can understand how they did it and what they've done. It's all based around a framework, leveraging the advantage of our EO. question from Joe. Can you talk a bit about why you might instigate a new EMI scheme alongside the new trust?
Can I touch on that one in terms of why we did it, or why we're doing it? We had an EMI scheme in place already for the management team. I think that's something that is fairly common practice in SMEs. I mean, particularly in our sector, where you've got different professional disciplines, you've got a multidisciplinary management team, and we're reliant on the engagement and the commitment and the growth of that management team to deliver the excellence in the service that translates to the commercial performance. So that principle is absolutely as important now that we've become employee owned, because in order to fulfill the objectives of the trust, we need to carry on running a successful service. And especially then when one of the main benefits of converting to the trust is exactly to have that mature conversation about stable succession planning. Being able to have a fresh incentive scheme for those kind of key management roles is absolutely a kind of a standard business tool and mechanism for kind of engagement and forward planning. So it's just as relevant in the trust as it is when we were just a trading company. And I think, just to speak to the point about, there is a benefit, of course, for all the employees collectively if we are commercially successful and deliver on our objectives. Then we have the ability for the trust to award those tax-free bonuses for the staff. So the management team are responsible for operationally driving the success of the business that will allow the trust to fund that. So it's another kind of example of this sort of virtuous circle.
Thank you.
Yeah, I think I'll probably just say on that, Kevin, I think you're exactly right, that there's often a bit of a philosophical point as to, whether all bonuses should be paid equally and everything equalised. Now, I think that there's a reality, isn't there, Kevin, in terms of actually it's a competitive market for the key talent in your business, like any other business, and putting in place that EMI scheme where you can incentivise those key people and retain them and help grow the business, which is in everyone's interest, is the right thing to do.
Thank you. Next question. We've got a few coming in, so I'm going to try and get through as many as possible. I'll answer the first bit. So what useful resource could you recommend to understand EOT legislation and EOT best practice? Hugh and everybody else, that's a combination of EOT legislation, speak to someone like Andy and his colleagues at PwC, and EOT best practice. As I've alluded to, the EOA's got a network of over 800 organisations who are willing to share. So combination of the two resources. To your more technical question, with regards to the EOT holding a controlling interest, is there much scrutiny/challenge on this area? Would the existence of a separate shareholder agreement and the rights within cause a concern? Andy?
Yeah, I mean, I think with that one, obviously, the key points to be met are that controlling interest test that I mentioned. So looking at, does the EOT have more than 50% of the shares, 50% of the voting rights, 50% of the dividend rights, 50% of the rights on a winding up. Against that, you would have to just go through any existing shareholders agreement or new shareholders agreement to make sure that that is met. There are certain then things to consider sort of line by line in relation to that. So technical points around the fact that it is fine if the EOT then waives its right to dividends, for instance, so long as that it's entitled to them in the articles. But it's quite a case-by-case one that you'd need to go through shareholders agreement and the exact terms to make sure that that controlling interest test is satisfied. In terms of scrutiny challenge, I think that we've seen one or two where HMRC have been now sort of looking into a bit more detail. But I think that the key is just making sure that you get the right advice to make sure that it's properly considered, that controlling interest test is met.
Thank you. Kevin's just posted an answer to the next question. So about the role of the trust board and the main board and who makes the decisions. As Kevin's highlighted, main strategic decisions made by the trust board. They still lead the organisation, but there's consultation with the trust board to make sure decisions are made in the best interest of the employees. So leadership still make those strategic key decisions on the main board. Next one, have you got examples of where a trust has gone on to do more than a traditional sale down the road? And are there any barriers to them doing this? So beyond becoming employee owned.
Yeah, so we've seen a few now coming down the pipeline where EOT-owned companies have been sold to third parties. I think that the main points, the sort of tax and legal considerations that sort of are a little bit, I guess the one point is that a buyer will want to see the valuation that was done, make sure that there's no risk that the company was sold for more than market value, and then a potential sort of income tax charge that could arise in relation to that. So that's, again, another reason why that valuation is really important. The other one is sort of around the fact that the think that the sort of warranties and indemnities that the trust would be prepared to give, which are likely to be sort of a bit lighter than a normal sort of selling shareholder. And in particular, that sort of goes to potentially why, if that is something that could potentially happen in years to follow, a selling shareholder might wish to retain a proportion of the shares so that they could give those warranties and indemnities. And then finally, and it's almost the really nice one of where you really want to be, is almost kind of the employee retention risk of actually, let's say a business is sold in year one, and then sort of 6-7 years later, is there a subsequent sale? Actually, there'll be a huge potential amount of money that goes into the EOT that then needs to be used for the benefit of employees, potentially paying sort of significant bonuses to employees or otherwise distributing them to them. And actually having a think about, well, actually, could there be a retention risk in terms of the sort of employees continue with the business going forward? Will you have a business left if you pay such big bonus? And actually what we've seen is sort of in those sort of circumstances, there'll be then deferral over a number of years, so the EOT would pay prescribed amount each year. I mean, probably very importantly, actually, to note that there is a clawback period in terms of if there is a subsequent sale and the CGT benefits that apply. So if there's a subsequent sale within sort of 4 tax years following the tax year of the EOT transaction, then those CGT-free benefits will be rolled back, and the selling shareholders will have to pay capital gains tax in relation to that original sale to the EOT.
Thanks, Andy. There's 3 questions that have come in, but I'm conscious of time. I'm just going to go to one. But James and Mark, if you want to go to the breakout rooms afterwards to ask those questions. So this final one from Gary: for a hybrid company, are dividends still paid in addition to bonuses? Andy, do you want to take that one?
Yeah, so that can vary. I have seen different structures there where dividends have been paid to remaining sort of selling shareholders alongside sort of gifts made to the EOT. It does sort of vary from company to company, that one, but it is possible.
Thank you very much. And thank you for answering those questions. Hello, everybody, and welcome back. I hope you found those conversations useful. Of course, don't stop asking the questions now. We'll be sharing in the email that comes to you afterwards the contact details from the team at PwC, and I'm sure the team at Amberleigh Care would equally be able to answer more questions if you need them. And of course, the EOA is always here as a resource. So next steps for you. If you are a member of the EOA, what you should do is, if we can just go back a slide, thanks. If you are a member of the EOA, what you should do is join the hub, make sure you log into the hub, continue those conversations and download resources that are available to you. If you're not a member, let us know, get in touch and we can explain more. First of all, if you won't mind scanning that QR code, tell us what you think, provide some feedback. Every time we do one of these events, they're incredibly successful. We can always develop and improve them going forward. So if you could take the time, that would be much appreciated. So, and further, what we've got coming up, to summarize in the next slide, is EO Day. So it's a reminder, if the team know you are thinking about employee ownership or you are already employee owned and you're just joining this webinar to hear how other people have gone through the process, do something on the 20th of June. Celebrate employee ownership in some way. It's a great mechanism for understanding what employee ownership is, internally and externally as well. The next slide, please. And just a reminder, EO Learn is a full training portfolio for any employee-owned organisation to really unlock the potential of your business. In these three cases, an impactful independent trustee, we've talked about governance and the significance, how to be a fantastic employee trustee director, and understanding employee ownership across your organisation, getting that EO mindset. And in terms of our events, we've got 3 coming up, all of them face-to-face and in person. If you're based in the north, please come and see us on the 12th of August at Wrigley's in Leeds. Down in London for the Robert Oakeshott Lecture. It's one of our signature events on the 1st of September. And if you're based in the southwest, on the 9th of September in Swindon, the face-to-face exchange hosted by Howden and the National Self-Build and Renovation Centre. And of course, the conference. We go live with tickets for a priority list. You can get yourself on the priority list potentially if you scan that QR code and join 850 people, 2 days, immersing yourself in all things employee ownership. You've done that for an hour and a half. Just imagine doing it for 2 full days and celebrating as well. So thank you very much indeed. Of course, naturally, thank you to Andy and all the team at PwC for supporting this. Thank you to Kevin, to Trudy and to Kelly for taking part. And thank you to you all for your posting your questions and joining us today. We wish you luck on your employee-owned journey.